Joining us now in the after hours is Ed Modla from the Options Industry Council. Ed's actually joining us from Texas. Are you not, Ed?
Well, that's almost correct. I am currently based out of Texas, but I am visiting the home base with my colleagues up here in the Chicago office. That's where I'm at today.
Oh, you're in Chicago today. Well, tell us a little bit about your background. Are you originally a Chicagoan that's moved down to the sunnier climates, and you've had enough of the cold winters that we experience here in in Toronto, and as well in Chicago?
You are absolutely correct. Born and raised in Chicago, went to school out here at the University of Illinois, and a little about my background. I bounced around the industry quite a bit. Started in 1997 after graduating with my degree in finance. Went straight to the trading floors, and that was a surreal experience as a 22-year-old on the trading floors of the Chicago Mercantile Exchange and Chicago Board Options Exchange. It was intense, to say the least. I worked for Blair Holt and his trading company. He's a legendary market maker, had a huge company out here in downtown Chicago. So I started to work for them. And guys, it was crazy. It was 1 hour of classroom training every single morning, then down to the trading floor from bell to bell, and then back up into the office for 1 hour of classroom training, all on options every day of the week. I did that for the better part of a year before they ever let me trade an option. So that was really how I got started.
Wow.
It was kind of
so
nuts.
you were clerking at the beginning, and then they
Yeah.
would teach you this like in the morning and night.
Yeah, before the bell and after the bell. So they were really long days. And you're right, clerking on the floor, I have to say there's no doubt that, that was the start of an incredibly stressful period. Now, being a trader and being on the floor is just a stressful job, but when you're first exposed to it, it is incredible. I was clerking, as you said. That means I'm on a headset. I'm relaying information between the pits that's coming across the wires, across the exchanges. I remember my first day down there, they handed me my headset, and I was going to start training and learning this stuff. And I kept telling the guy who's training me, I said, my headset doesn't work. It's off. There's something wrong with it. You got to plug this thing in. That's how loud it was down there. I couldn't hear a damn thing on the headset. But he's like, listen, give it a week, give it 2 weeks. It's a trained ear. You'll figure it out. And I'm telling you, I thought the thing was off and not working. That wasn't the case. I just had to train my ear for what I was listening for. And eventually I figured it out. It really was one of those jobs where you put in a full day, you're sweating, it's over, you're stressed, you've had enough, you're ready for happy hour. You look up and it's like 9:30 a.m. You're just like, holy cow, the clock is running backwards. That's the way this job was at the beginning, and that's how my career started in the business.
So did you start at the Merc? Like, were you doing straight like futures, or did you actually go right to options right at the beginning?
It's always been options. So I started at the Merc in the options on futures pit of the S&P. So it's a little different. SPX is the options on the cash, and then you have the SPH options on futures. So I was on the futures side, and just the environment very different between the two pits. And a little bit of detail about here in Chicago. The Mercantile Exchange is a very loud pit, loud trading floor, and just had a different dynamic to it. And I don't think anyone who was on that floor would be offended that the traders and clerks down there, they were referred to as meatheads, and that's what they felt like, and that's what they looked like, and that's what they sounded like. That's what they were. And at the options exchange, across the street, they called that the country club exchange because it was quieter, it was more spacious, it was a little calmer. Don't get me wrong, that's within the world of trading. There was no such thing as calm, but between the two, the Mercantile Exchange was really intense, and that's where I got my start, but always on the option side.
Wow. So that's a great story. And so, what did you do from there? Did you get to trade? How any good stories from any of the big moves?
Well, trading was great.
During this?
Yeah, so trading was great. I always say I wish I was born 5 years earlier and got my start in the business in the early 90s. I'd be sitting on a beach somewhere drinking margaritas, but I started late 90s, so I only had a few years of really good activity down there. At the end of my tenure on the trading floor, I was in the Amazon pit. Now, that was a wild pit. We're making lots of money, doing really well. But fast forwarding in my trading career, but backing up from today to, I think it was 2000, 2001, Amazon was a $10 stock, $11 stock back then for a little while. And there's no opportunity to make money when you're a market maker in a stock that cheap. So got pulled off the floor around then and started trading electronically. And that was tough. That was relearning, starting to do technical analysis, fundamental analysis, having an opinion. As a market maker, you're trading for edge, bid, offer,
Right.
trade on either side of your theoretical values, set your implied vols appropriately, trade for edge, make money. You go off floor, the edge is all gone. And it's all about market analysis, having direction, having an opinion. So I had to go through a learning curve. It was tough, but really valuable for my career to learn all those things. I probably, it was close to 10 years or so where I was an independent proprietary trader in options mostly, and then some stocks and some futures that I would dabble in here or there where there was opportunities, a little commodities jumped into the mix when they were moving around quite a bit. But there was a good section of about close to 10 years of my career where it was all trading online.
So, Ed, I have a question for you how it worked at Hull Trading.
Mm-hmm.
Did they give you the curve that you were supposed to trade off of, and then you basically just made a market from there?
So good question. So yeah, it was almost like that, a little more complex. So we had a very sophisticated system, and a lot of it was controlled by the partners of the firm. So they were running their mathematical models all day long to derive theoreticals that I could see on this, what I'll call a little handheld computer. But within the handheld computer, I also had the controls to go in and take the vol curves and change them and adjust them anytime, anywhere I want. And of course, vol is different at every strike price. So as I'm in the pit, this was essential to do it this way because I'm in the pit, I'm seeing order flow, and I know what I'm trading. So if I'm buying options, or even if I just see orders coming in on the sell side offering options, I have to recognize that and start dropping vols at those levels and at those strike prices. So as I made those changes and I clicked and dragged and tweaked my vol curves and reset my theoretical values, then exactly as you said, I'm watching the screens, I'm seeing where my values are at, I'm trying to make the best markets I can and beat everybody else to it. On the bid offer side, trade around that for edge, and then hedge the position and keep my deltas and Greeks as flat as I can, trying to be long, short, long, short, long, short from one strike to the next, up and down the line. That was the objective.
And so let's just say you thought implied should be 30 for a particular series. So you bid 29, you get hit, you hedge it up on the delta. Do you then send it upstairs, or do you continue to hedge and kind of take care of that position?
A little both. So every trade we made, I would put through the machine that I was holding in my hand in the trading pit. Every trade was witnessed by the partners upstairs. They saw everything in their NASA control center, which had hundreds of screens up on the office. So they're watching everything that was going on, and of course they always had the authority. They could send me messages. These were nightmare messages. You'd get popped up on your screen like, what the hell are you doing? Stop doing this shit. You're trading, you don't have the ability to always make the trades you want to trade. Brokers come in with orders, you're giving bid ask, that everyone's making the best markets you can. Sometimes they're just jamming things down your throat. What are you going to do? You buy things, you buy more. So you weren't always pleasing those guys upstairs. And so that's when that other element that you just referred to comes in. It's their money, ultimately, the partner's money. And so they also had the controls to come in and hedge positions to offset, to do other things. So really it was a bit of both. I had full autonomy to handle the position, hedge it, tweak vols, and trade off my theos. But those partners came down on me when they had to.
Right, but the book as a whole, did you have to manage the delta, like as it moved around?
No.
So you're going to be that went upstairs. Yeah, okay. So the gamma
so
and the
I'm
delta
trading
went up.
Amazon.
Yeah.
Yeah, right. You're right. So I'm managing Amazon and WorldCom and Gillette and all the options that I was trading in the pit. That was my pit and what I was doing. Now the managers every single morning would talk about exposure across the spectrum of equities. I think that's where you're going with this. We got traders all over the place. The firm has overall risk that's going to be different from my risk. So we had a morning meeting every single day that talked about those risks and where they wanted us to lean with our positions to make sure they balanced out.
Okay. And then on the whole, were you guys generally short gamma? Like, was that kind of a...
Yeah.
So that's how I was just so you know, my background is on the institutional side, and I can't tell you the number of times that I was long. I was always short. Was it the same at Hull?
Well, yeah. No. So at Hull, the general perspective and approach was to be slightly long gamma in equities and slightly short gamma in index options. That was the approach that we took, and then generally the positions that we wanted to have from one day to the next.
Right. So I was an index trader, and that's why because usually index traded fatter than realized, and individuals would go, individual equities would trade cheaper, or at the very least, it was the dispersion book. Like that's in essence what they were doing, the dispersion trade, right? Where they were long individual names and short the S&P or whatever, the index book.
Yep, that's exactly right. There was a team of index traders that had the slightly different parameters than we did. They managed their risk appropriately. But then within that team of index traders, which, back then we're talking Dow, OEX, SPX, SPH, we had a slew of guys in the equity pits, including myself, all across the trading floor. And slightly different gamma positions were the target goals between the index guys and the equity guys.
And so, does that game still exist? Like, are people still doing that? Like, what do you see as the differences, the changes, most kind of obvious in the last kind of 20 years?
Yeah, so I don't see that happening as much, if at all, now. So with the way markets are now, one of the things that really drove everybody off the floor and really destroyed the market making business. Of course, it's electronic trading. We know that high frequency, but when you went to multiple listings and you went to pennies versus fractions, remember when I was on the trading floor, if there was an option that was worth, say $3, I mean, the best you're going to get from me is 2 7/8 at 3 1/8. And that's a quarter wide, and you're not getting anything better than that. And you look at today's markets when they're nickels and pennies wide, the edge was completely gone for the market maker. So when I look at things today, from my perspective, I don't see the ability to trade for edge and trade the way we used to trade. I think you got to have an opinion. You have to be doing directional opinion, or the sophisticated firms are actually looking at implied vols. They're looking at what I call historic implied vol. They're not looking at historic of the stock or implied on the options today. They're comparing today's implied with past levels of implied and then evaluating that and maybe trading straddles or just going long or short gamma based on their opinion. Is vol out of line today? Is it going to gravitate towards its long-term mean? Bottom line is they have some sort of opinion and approach. We never had an opinion. When I was on the trading floor, one interesting detail, we were not allowed, or there was a firm-wide rule, no TVs in the house. We don't want anyone watching CNBC and watching the market move up thinking they got to go long delta. I mean, it was literally a rule the partners had. We don't want you to have an opinion on direction. We want you to trade volatility as it's coming in the pit. We don't want you to think vol's low in your mind. We want you to respond to the order flow that's coming in the pit and move your vols that way. If there's buyers, move it up. If there's sellers, move it down. But don't move it because Ed Modla thinks vol is too low. I mean, that was the bread and butter of their philosophy. And we were told constantly, they said, look, guys, we are the house. We are the casino. The odds are in our favor. All we want are people coming in the door, sitting at the table, and playing the games because the odds are in our favor. And if you stick with that analogy, real quick, once things changed and we went to pennies and we went to multiple listings and the bid ask shrunk, the house didn't have any edge anymore. And then that business model and that philosophy really fell apart.
Now, every once in a while, I like that analogy you're using of the house, and every once in a while, the house has to eat it. Is there any times that you remember where there was some sort of event and and the market makers, as market makers, you guys just ate it all?
It happened a lot, especially when you went to this multiple listing. Back in the day, if you traded IBM options, you had to go to Chicago to do that. And if you're trading whatever other equity you were trading, you had to go to a certain exchange or city to do that. When you went to multiple listings across all the exchanges and all the symbols, there was a lot of competition going on. And we would get orders sent to our floor. SIBO wants the print to be on their exchange. So there was a lot of pressure on us, on the trading pits, and on the DPMs, the designated primary market makers, to keep order flow. And you're right, we were eating a lot of trades we didn't want to eat, and we were taking size down on trades we didn't want to. I remember one trade came in, this is going way back, so I hope I get the details right, but broker came in to quote a high delta, maybe 70, 80 delta call on Gillette. And this is a stock. I'm not going to trade size on Gillette, so I give them a market, and I'm 20 up. Normally, I was 200, 300, 500 up on my markets. I'm 20 up on this 80 delta option. I don't want any part of it. Everyone else is doing the same thing: 20 up, 50 up. Broker's like, all right, I got 2,000 to sell. DPM's like, you're filled, and then just gets on everybody. Hey, as a pit, we got to take this down. We got to take this order for the exchange and for the print. Who's doing what? Everyone's taking 2-3 times more than they wanted to, and guess what? Stock gets hammered. We get crushed. Remember what I said earlier? I get those messages on my handheld machine. I can't tell you the language that I got on that machine, and then I had to deal with the phone
Yes,
call
you can
upstairs.
say it.
And,
tell us the language you
well,
got.
I mean, it was ridiculous. It was ridiculous. So what happened there, and it was such a ridiculous frustration. So I had to leave that day. I mean, I threw my handheld. I was dealing with just a bunch of stress because I'm telling my partner, the position managers and the partners of the firm exactly what happened. They're like, "Oh, you're full of shit. That's bullshit. That doesn't happen." They're trying to send me back into the pit to take the other side of the trade, and I'm like, "Are you nuts? If I go back in the pit trying to get out of the trade with the other market makers, they're going to beat the crap out of me for saying something like that." I mean, it was just a nightmare. But back to your question, yeah, we had to eat trades to get prints on our floor, and the designated primary market makers, well, they controlled the pits. You had to sort of bow down to them sometimes when they took large orders and get on the ticket with them. That was one of those examples. I didn't want any part of it. Nobody else did. We got totally ran over, and then I got it hard from the partners of the firm when they saw what happened there. But that happens sometimes, and then you had to deal with that.
All right. So now, from all of your experience, the question I have for you, when it comes now to your personal accounts, are you inclined to harvest data, or are you still like the idea of playing direction on the markets? What's your preference? I mean, you can do both, but if you were on balance to slant one way, which side are you on?
Well, as I made an evolution there from the trading floor and trading for edge and really trying to be flat everywhere into directional trading, that really took over my preferred style. And as I said, I had to learn a new way of trading. This goes back to the early 2000s and mid 2000s, learning technical and fundamental analysis, how to interpret, what studies I prefer to use, and then translating those studies and analysis into a trade. And that is what I prefer to do today. I like and I enjoy using technical analysis, looking at the fundamentals, forming an opinion on direction, and then finding out, as I said, what tool am I going to pull out of my box here to trade? Sometimes it's just stock. Sometimes it's just futures. Sometimes you add options to it and tweak and change the risk profile. But I'm currently a directional trader, more short and medium term. Don't really hold things too much on the long-term side because I'm active, and that's just my nature. I like to trade a lot and be in and out of positions and keep moving into different things. The money's moving around quite a bit, so definitely on the directional side these days.
I love the fact that you kind of use that analogy of a toolbox, because I have a lot of big picture trading members that approach me and say, "What is your favorite option strategy?" And they ask me I'm about to explain to them this one amazing thing, and I kind of I always use the analogy, which is very similar to yours, and I say, like, it's like a carpenter. You have a tool belt, and on there you got 20 tools, and you ain't gonna pull out the hammer to put in a screw. What you do is each option strategy is like a different tool in your tool belt, and what you do is you size up the situation and you pull out the tool that is right for the job. You don't want to just say, "I only ever use a hammer." Right? Yeah, you don't want to pigeonhole yourself to just one option strategy. You want to understand why you would use one option strategy, and then you understand, are these the conditions when that option strategy is most appropriate? Is that a good way of putting it? Would you look at it the same way?
Not only do I look at it the same way, I get the same question all the time, and people will say, and it's usually from the people that are starting to learn. They'll be like, "Hey, which strategy works the best? Like, which option strategy makes the most money?" And of course, it's like, well, they work as advertised. Options are not going to lie to you. They're going to work as they're showcased, bullish, bearish, neutral. But you have to know a variety of strategies. Put them in your toolbox, know when to pull out the right one. But then, there's more to it than that, not to make it too complicated, but what's the right strategy? How do you put it together, choosing strikes and expirations? And then, you don't set it and forget it in the options world. You're monitoring where the underlying is going and when do I need to make tweaks and changes. And, going through different strategies, and I often tell people, you're going to learn strategies by their by their name and their broadcast name of straddles, strangles, and covered calls. Well, that's just simple terminology, so we all know what we're talking about. In a live account, at least what I would say from experience in my own trading background, in a live account, you're tweaking and changing things to look exactly the way you want them to look, and probably don't resemble one of those strategies that we know by name just because you're changing things a bit. By no means am I saying that those strategies are not the way to go, but there's all different ways to implement options. Having a toolbox ready at your disposal and tweaking and changing things to your liking to really fine tune your position the way you want it, that's the way to do it, and that's the way it works.
Yeah. Well, listen, Ed, I'm going to change the topic up a little bit because, we got an opportunity to be together at the Toronto Options Education Day. I'm actually flying out next week to do the Options Education Days in Vancouver and Calgary, and it's too bad that you're not going to be out there. That would have been a great time to get caught up, but just a plug for our listeners to take advantage of these Options Education Days, and whether they're here in Canada, but then I know that you guys do a whole series of them all over the States, right?
We do. You're right, by the way. I was going to back you up on that. The Options Education Days are terrific. I would have loved to have been there. And next week, this happens to fall on Thanksgiving week. It's a big deal out here. I can't pass up the meals that I'm gonna be chowing down over.
Don't blame you, buddy. Don't blame you.
So the scheduling conflict didn't quite work out the way I would have hoped. I would have loved to have gone up there for more because they really are terrific education days.
That's right. So listen, it was great to have you on. Why don't you just quickly let all of our listeners one more time, let them know where they can get more education from the OCC and where they can learn more about what you do.
Sure. Well, there's really two places I'll mention. First of all, the funding that we use to provide all of our education comes from the Options Clearing Corporation. You go straight to their website, www.theocc.com. Find the Education tab. That'll take you over to the Options Industry Council. If you want to just go straight there, you can go to www.optionseducation.org. Either way, you get to our education. And the first thing I'd encourage you to check out, as you said, the upcoming events. Sign up for the webinars we've got coming up and any live events that we simulcast. That's probably our number one offering right now. So sign up for those, and we hope you enjoy them.
Well, listen, Ed, thank you very much for joining us. It was great to have you on the show, and hopefully you'll make time to do this again with us.
I would absolutely love it. Thank you very much for the invite. My pleasure to be here, and I hope to do it again.
All right. Thanks a lot,
Ed.
Ed.
Take care.
Thanks, guys. Bye-bye.